to present. So Anchor Capital is a company, we're based in Raleigh, North Carolina, founded in 2008, and we think we have something very special in terms of a fundamentally driven, highly concentrated strategy of investing in small cap, publicly traded companies that are generally around $1 billion in market capitalization. And we have a team of 5 employees that are very cohesive, have been working together for a number of years now. Our goal is capital appreciation. And let's see, a little bit about myself. I began my professional career in 1990 with Ryder System. That's when Marty says we go back 30 years. We joined Ryder at the same time. I spent 3 years in financial analysis there until I decided to move forward into investment banking with a boutique firm that specialized in mutual to stock conversions for savings and loans. So I managed a series of around 45 initial public offerings of small savings and loans around the country during the 1990s. And then in the late 90s, left to go into venture capital and founded a company with 2 technologists that had come out of IBM at the time that thought they had something very special in artificial intelligence that IBM didn't really value. And so they licensed that out. We formed a company by the name of Saffron Technology. And so I spent about a year there raising initial capital and hiring some people for that company. We were way ahead of our time. Then I believe it was finally 2015 when Intel acquired the company, and that's now the embedded artificial intelligence and Intel chips to compete with IBM Watson. So it was a complete write-off for 15 years, and then ultimately it worked out. So it was a lot of fun. I left Saffron after about a year of startup, though, to join a strategy consulting firm out of Boston. And that was about a 3-year tour until I went back into my second venture, which was a digital textbook company by the name of Vital Source Technologies. And that was a special little company that had effectively found a way to digitize textbooks and provide those to students in the classroom, had gotten it started in the dental market, and we grew that into partnerships with Apple to provide digital content on the laptops and machines they were selling into education at the time. A similar strategy and partnership with IBM, which became Lenovo in the process, and then we sold that company to a family office owned enterprise in Nashville, Tennessee in 2006 by the name of Ingram Industries. And at that point, I was looking around saying, okay, what's the next venture? And I had 2 small children at the time, and you've got all these expenses and you're going to really start up another venture. And just happened to find a small publicly traded company that looked like it would make an interesting investment at the time. Pulled together 3 investors and $1 million in capital. Let's roll forward to the next slide here, to start Anchor Capital in 2008. And truth be told, I didn't mean to start a fund with $1 million. There was a degree of insanity in that, and it was really meant to be an investment, just on the side while I was looking at other venture opportunities. But then we found another investment and another, and over time we had more and more people that were through just personal relationships that wanted to invest a little bit with us, and so it started to grow. And so you can see that in 2012, we founded what we currently manage today, which is a limited partnership fund by the name of Anchor Capital with $5 million. That has grown now to, as of the end of 2021, to a little over $100 million in assets. And I think the thing that we're probably as a team proudest of is that that's on a base of around $50 million in capital contributions. So half of that growth has been through compound. Let's go back, Marty, please. Yeah, half of that growth has been through compound returns over time. And we've, over time, only had about $3 million of investor withdrawals. So it's a very low turnover in the investor base. There are around 90 limited partner accounts from about 60 investors. Some have various trusts with us and things. And the general partner is a 7% owner in the assets of the fund. So what we look for, and let's now roll to the next one. Thanks, Marty. Thank you. In our portfolio construction, we're looking for great little healthy companies that are below the radar. This is an overlooked market in small capitalization, public traded companies. And we only invest in companies that have positive cash flow. We like companies that have a niche leadership position with a strong culture led by good management teams. So we meet with management teams. We do site visits. We talk with competitors. We do all the fundamental analysis over time. And around 75% of our analysis is qualitative. We think that the culture and understanding of a company, where it fits within an industry and how it's perceived by other industry participants and employees, is very important. So this is what we spend our time doing. Our current fund portfolio is 8 equity investments, which is about normal for us. So when I say concentrated, I mean seriously concentrated. So we have positions that range from 6% up to 20% of the fund right now, and we're carrying 5% in cash. And we normally are around 1% of common shares outstanding on a company when we go into that, and we watch our liquidity very carefully. So we generally will invest up to 1 or 2 times average daily trading volume. So we have the ability to move out of stock when we're ready to, or if we need to. On average, our fund has been about 25% in cash, and this is not from a top-down management standpoint of market timing or market cycles. It simply bottoms up of doing the analysis on companies, investing with preset returns based on our own valuations. And when we hit those sell targets, then we'll sell, and that converts back to cash. So it's really investment timing that drives the cash balances, not market timing. We've been invested across 8 sectors, 60 investments since inception, and you can get a flavor. These are all basic, simple, easy to understand types of companies that have healthy balance sheets.
What's the variability of your cash? It looks like you've gone anywhere from 60% to less than 10%. Is that right?
Well, and we're currently at 5%. So yeah, the maximum in cash, that's over the past 5 years. I mean, the fund started with 100% in cash, obviously, and came down quickly in 2012 as we began to allocate that out. But so yeah, a high of 60 and kind of a low of 5% in cash is where we stand.
Okay.
So yes.
I don't know if later on you're going to get to the duration of your average investment, or
Let's roll to the next slide here.
okay.
So have these investments done over time. So we've made 60 investments. We currently have 8 in the portfolio, so that means that we've invested and already harvested. We bought and sold 52 of those investments. We've had 7 that have produced negative returns out of that. So batting average or success rate is 865, or a little better than 85%. These investments generally are long-term in nature from at least a tax standpoint. We will make 2 to 3 new investments per year, and we'll harvest 2 or 3 investments per year. And the average holding period is somewhere between 15 to 18 months in that time frame. So generally, the investments are driven by soft catalysts. We've only had 5 out of here that have been harvested as a result of a M&A or takeout transaction. So this is buying at the right price in companies when the market is off, or when the company's had a bad quarter, or they've missed expectations because the street expectations were out of alignment with where they should have been, and so they're sold off by the algorithms, and then you have an opportunity to invest in these. And so it's generally a 1 to 2 year holding period.
Yep.
That's what I would say with it. So if we move to the next slide, let's talk about a few companies here, and it's interesting. So all of these companies, and there are 3 here that I'll touch on: Energy Recovery, which is based in San Leandro, California; Iridium Communications, based in McLean, Virginia; and Concrete Pumping Holdings, based in Denver, Colorado. There's similarities. These are very different companies, but what they do have in common is they have exceptional leadership teams. They have niche leadership positions within their respective markets, healthy balance sheets, attractive gross margins, attractive EBITDA cash flow margins, and they have winning cultures. So we've spent time with each of these companies and know the management teams well, or have been invested in these in the past. And they've come from different sources. So typically, about half of our companies that we invest in, we find through screening, and we'll uncover, what we think appear on the screen to be attractive companies, and then we'll dig in and do more due diligence and learn, hopefully what the real story is on a company. And so energy recovery, this is a water thesis. Water is a big issue facing the world. It has been for years, and everyone's trying to figure out a good pure play on water, whether it be water distribution or, conversion of salt water, to drinkable water through desalination. Energy recovery is kind of a picks and shovels play behind this market because it's a technology company, effectively. They, an industrial technology company, they have what's called a pressure exchanger, which when used in a process of reverse osmosis in water desalination plants helps to drive down the energy cost of desalination by about 65% to 35 cents on the dollar compared to the traditional thermal measures of doing this. So they are installed in every major water desalination plant in the world, 100% market share there. Across all desalination, they have around 80% market share, and that's a growing market. There continue to be new desalination plants, especially in the Middle East area, that come online, and they're included in all of those. But they just sell this pressure exchanger. So it's a ceramic device. It's fascinating to watch it, built through an 8-step process, starting with, alumina powder, and then, mixed and shaped, and then put through a kiln, and they sell it for a nice margin. It's a 70% gross margin business. They're now applying this technology to other markets, including industrial wastewater treatment, and they found a way to apply their devices to a state of gases as well, and the real focus there is in refrigeration. For instance, grocery stores that have a refrigerated section that's typically cooled by HFCs, and the world is moving away from HFCs over to carbon dioxide, but that's a much higher energy cost to cool using carbon dioxide. With the application of their pressure exchangers, you can bring the cost down to equal to what it is with HFCs. So
are these all domestic U.S. companies, or?
They're all domestic U.S. companies. And so Iridium Communications, to touch on the next one, is a satellite communications company that has a unique network of satellites in orbit in what's called LEO, or low Earth orbit. And their customers are ranging from the Department of Defense through to Caterpillar, which will install Iridium devices on machinery that's put out into the field around the world for tracking. And they also have a partnership with a company called Aireon, which they founded and spun out as a separate company that now provides flight tracking across over half of the world's complete airspace, and is used by air traffic control. So it's an absolute fascinating company with a high competitive moat around it. Concrete Pumping Holdings is very different. It's a service business, and if you go to a construction site, whether that's a commercial or a residential construction site, you're going to find that nowadays you use these pumps and booms, to deliver the concrete, as opposed to seeing people moving around with the wheelbarrows and up and down, much more efficient. Well, this company never takes ownership of the concrete. They simply show up at the beginning of the day with the pump, they operate the pump, and then they leave at the end of the day. So it has very attractive margins. It's a low capital intensity. It does not have any exposure to the commodity risk, or supplies that go into concrete, such as the cement, the gravel, and other types of things. They're based in Denver, Colorado, and that's the smallest market cap of any of these companies. It's a little below 500 million, but that's a good.
What happened to that company in 2018?
Which one?
The BPCP. That was a huge
The BPCP?
Yeah.
Well, what happened in which year?
In 2018-19, there was a huge dip. It was trading at $10, and it kind of lost market.
Well, that's the beauty of a SPAC, right? Okay, so this came public through a SPAC, and so you'd had some private equity ownership that had gone into it at $10 a share, and then you had a liquidity event following that, which was financing for an acquisition into the company, and that came out at $4.50 per share, and so that's where you see the spike down. There was when it really became liquid as a public investment there. And so we invested after that. We were not a SPAC investor. We invested in this in 2019, and it was in the $4 range, and COVID rolled around. It got to $2 during COVID. We kept close relations with the team. The CEO, Bruce Young, actually came to Raleigh and spoke at our annual general meeting last year and did a fantastic job. It is now trading, I'm not sure, somewhere in the probably the $8 range today. We harvested the investment in that at $9, so that was a nice return.
Right?
Pardon?
You guys exited, right?
Yes, we did. We did. So, but good question. Thank you. So
Most of these companies are listed on NASDAQ, or where are they listed?
well, these three are listed on NASDAQ. We do invest in some companies that are that are on the NYSE or Amex, but these happen to be NASDAQ companies. Yes.
Next one.
So, good. Yeah. Next one. So how do we view risk? I think an important element here, we do not view risk as volatility. The world does, but we look at it as the likelihood of a permanent loss of our capital. So the way that we manage that really on two levels: at a position level, through intensive diligence, we perform our own internal valuations and models on these companies. We set strict trading parameters. The most important thing in these is to know what you're investing in and to buy it at the right price. That sets you up for success. And we know going into an investment what we'd like to sell it for. And if it hits that preset level, we're gonna take money off the table, as opposed to sitting back going, oh, it's running, it's doing well, it'll keep going, and so this feels good. Because our belief is we found that what goes up must come down at some point because of the market volatility. We maintain good position liquidity and engagement with management, give away a lot of free consulting and ideas there. And at a fund level, we have a very stable capital base, on average around 25% in cash. That varies over time. We don't use any leverage. We don't use any derivatives. So our balance sheet at a fund level is cash and tier one investments in publicly traded companies. And we believe we have a clear understanding of our investments and how to manage those, a good team and excellent service providers. The world generally, and this I guess really began with the evolution of modern portfolio theory, came to view volatility as the proper measure of risk, and that's a fair way to look at risk, different from how we do on the portfolio. But in terms of some volatility metrics, you can see the Russell 2000, the maximum drawdown on a monthly basis was March of 2020 of close to 22%. We were down that month 18%. We ended the year of 2020 up 30%. The Russell ended the year up 20%. Standard deviation on ours runs a little bit lower than the Russell, and our Sharpe ratio on a 5-year basis comes in at a 1 versus the Russell at 0.6. I mean, the Russell's just continued to be volatile and underperform over time. So how does that translate through into returns? Let's go to the next slide. Over time, on a 5-year basis, our annualized net performance is around 15%, which runs a little better than 500 basis points ahead of the Russell. You can see, the 2021, what occurred in the month of January of this year, when we were down 6.6% versus the Russell 9.6, and this is generally kind of how it runs, is several hundred basis points ahead of the Russell 2000 index. And today's an interesting day, right? I mean, it's been an interesting month, so we'll see where the future holds. This is past performance, and our compliance people tell me I have to say that this is not indicative of future results. But we believe we're heavily invested in this. We believe in the strategy and think it's so simple that it works really well, and it's often overlooked in terms of the world of finance and the proliferation of products out there right now. We're actually up in February, so year to date through 11 o'clock today, we're down around 4% versus the Russell down around 14%. But again, that changes minute by minute. Co-investments, we've offered over time. Some people find these appealing. Some people find that they're maybe a distraction, but we've done 12 of these Since we began, these are outside of the fund. These are set up as separate LLCs, and we just pass the hat to our limited partners and say, if anyone would like to chip in, you can do that. And these are additive investments. So when we do these, it's because we've got a position in the fund that we've hit a capacity constraint on, either from liquidity or percent of AUM, and we think it merits additional capital. So we'll pass the hat and form these. We've done 12, they've all worked, knock on wood. And the internal rates of return have been higher than the return on investments on these because they tend to be short-term in duration. So they're not tax efficient, but some people like saying, oh, let me see the analysis on the company. I like that. And they send a check, and then within a year, they get a check back. So that's
So
it.
typical duration is less than 12 months?
On all of these, the duration has been less than 12 months. Yes.
Do you use a BD?
BD?
Do you use a broker dealer or?
We use Wells Fargo Prime Services for our prime broker. Yes.
So they do the placement or you just?
No, they don't do that. That's a good question. No, we form the LLC, we form a separate account, and we do this. So we don't operate through any intermediaries at all in terms of access to capital and relationships with investors. In fact, we've never used a third-party marketing firm to raise capital. It's all been through relationships and referrals.
So it's so special purpose vehicles for all of these co-investments?
Right.
Yep.
It's a good question. So
Next.
that's it. Additional information. Thank you very much for your attention. If anyone has questions.
Let me just escape from this and then we'll go to questions.
Sure.
I'm a value investor as well, so I'm a pretty big fan of what you do.
Thank you.
Do you drive value via activism if needs be, or most of your positions are just passive positions, just waiting for the market to realize?
I'd like to think that we are a major contributor to value creation, but truth be told, you can have very little influence on a publicly traded company. So the majority of it is passive. We do not get onto the side of being an activist investor trying to drive change when we see a management team that is doing something different than the investment community would like. There are plenty of those funds out there that do that. I mean, I tend to be, and we as a firm tend to be an optimist and to form positive relationships with management. So we give away a lot of free consulting. And that can be in terms of introducing companies to other potential partners, to potential board members, running analyses on the breakup value of the company, or what would happen if the company were to divest this division or that. So we do a lot for the company. How that filters through into the stock price, it's anyone's guess.
So Clay, there's a question from the audience. Rob,
Sure.
are you there? Rob Colorina, did you want to ask the question?
Yes, thanks, Marty. Can you hear me okay?
Yeah.
Okay, great. Thanks, and good presentation, Clay. Greetings from California. I put it in the box there, but what's the approximate makeup of your LPs between institutions versus family offices and individual investments?
Good question. Thank you. I would say that we have 8 institutional investors that constitute around 30% of the fund, and these institutional investors they're based on relationships too that we've been taken into from family office or individual investors. So, in a case, we have a foundation of a cemetery in the Mid-Atlantic that's a major investor with us, but 2 of the 3 trustees of that have become investors in our fund individually and then led that investor to us. So family offices, I would say that's probably 30%, and the remainder is high net worth individuals. Okay,
Thank you.
Thank you.
Yeah, so given the existing, turbulence that's going on globally, do you have targets who typically do better when, in domestic environment versus global environment? Or are there any winners that you've chosen? Can you talk about how you've approached the existing climate today that we're going through?
Well, I mean, whether it's the situation in the Ukraine or whether it's the Fed and the outlook on rates or COVID, I mean, there's always a flavor or two of the day. I mean, there's always going to be something that drives risk, and if nothing really exists, then, frankly, I mean, people will find it reason to make a mountain out of a molehill. There's always volatility in the market and the climate. Ours goes back simply to looking at companies that have a durable, competitive position that's reflected in solid margins, that have good organic growth opportunities that we can value internally based on cash flow. And then looking and saying, all right, if we think a company over a 10-year period is worth $100 per share intrinsically, and we have the opportunity to buy that in the market at the trading price today of 50, regardless of what the environment is, as long as there are healthy fundamentals in the industry and within the company, that's a margin of safety for us. And then we'll take the money off the table when it approaches 80% of intrinsic value. So it really strips out all of the background noise in the environment. It's worked over a number of different cycles and very volatile periods.
So about 100% of your opportunities are what you would call growth opportunities, right? I mean, you're not like looking at companies and say you should sell off the division and, your pure play is better.
These are not event-driven or expected event-driven. These are, pure, fundamental valuation, companies trading at a level that does not represent the intrinsic value of the company. And so those can be growth companies, value companies. I mean, someone asked the other day if we, would invest in, value companies that are not growing. And I think that, the company's not growing, it's moving backwards. You can't stand still in the world. And so, but these are not hyper-growth companies dependent on the future. Yes?
So why is your horizon only 12 months? Why is your horizon duration is only 12 months?
Well, it's between 12 and 24 months in that period because what we've always believed is that if we can generate base hits and doubles, we're not aiming for the home runs in investing, and generally we get there with a 30 or 40% rate of return within 12 to 18 months, and then we'll take the capital off the table. And out of our 60 investments, that's across around 30 companies. So these companies will have stock prices go up. They'll run, for instance, an Iridium. We invested at $9 a share originally. It had gotten up to around $35 per share, and then along comes Kathy Wood with the ARK funds. They begin buying it. Reddit follows on, Wall Street bets, et cetera, and the stock's at 55 before you know it. And it's above our intrinsic value estimates at that point. We sell that, okay, then Kathy falls on harder times, okay, the market's turned, she has to harvest the investment, it's back at 32, well below our intrinsic value estimate, so then we'll reinvest. So we maintain relationships with the companies even after we've sold the investment, because generally there'll be another opportunity to get in at a price, but it helps to preserve the capital, not being greedy in these.
Can I just ask you a question that's more specific about the satellite business? Because it seems to me like with that the price per launch has really gone down dramatically, right? Of launching whatever the certain amount of pounds or kilograms you're launching. Can you talk about that and why that's what kind of opportunity it is, or is it overvalued right now?
The satellite?
Yeah,
opportunity?
Yeah, right. I mean, obviously, I guess SpaceX is launching a network and other companies. Is that becoming more competitive or just, so?
Yes, no, good question, and that comes up, all the time. So Iridium was originally created by Motorola. They thought we'll put these satellites up in low Earth orbit and we'll sell millions of sat phones, and they put the satellites up and they sold a couple of dozen phones. And so it went bankrupt, but they had picked up the Department of Defense as a client that helped sustain it, okay? And then it came back public in 2008 under the new leadership. By that time, it was time to replace the satellites that were there. And so they went through a $3 billion capital program through 8 launches with SpaceX and put up 66 new operational satellites and another 9 in orbit spares. So that was a $3 billion project. 10 years or 15 years from now, when they have to redo that, my estimate is that the cost of launch will have fallen in half. So it's coming down because of the cost of launch, the cost of manufacturing. It's all becoming a bit more. It's not a commodity industry yet, but the pricing is steadily coming down with private enterprise that's come in to break the mold on what used to be a government industry of satellites, of rockets.
I have just one more question,
Yeah.
and it's related to the fund structure. So, do you take separately managed accounts, or most of the people in the fund, you know, et cetera? What, can somebody be in an SPV who's not an LP? Just talk around that.
So we concentrate all of our investment activity and investors in the fund. So they're limited partners. We do not have any separately managed accounts. The special opportunity, the sidecar funds, those are separate, but we simply go to our investors and say, who wants to participate? You can come into this if you want to. So we don't offer those co-investment or special opportunity funds to people that are not currently investors with us.